A $2 billion AI deal just got shut down, not because of business, but because of geopolitics between two superpowers, China and the United States. Meta tried to acquire the rising AI startup Manus in January, then announced the deal, and everything looked normal until it didn't. Chinese regulators stepped in, the two co-founders were called to Beijing, their travel was restricted, and the entire deal was forced to unwind. It is not just a failed acquisition. It is a glimpse into something much bigger. A world where artificial intelligence is no longer just innovation but power, where talent cannot freely move, where companies cannot simply go global, and where governments decide who gets to own the future. We don't blame China or the US, both are doing the same thing. So what really happened behind the scenes? Why did moving to Singapore not protect Manus from China's control? And what does this tell us about the growing AI Cold War between the United States and China? Because this story is not just about one deal, it is about the rules of the game changing in real time. So today, we are diving into one of the most fascinating and frankly, tense developments in the global AI race right now, and that is the blocked acquisition of Manus by Meta Platforms. At first glance, this might look like just another corporate deal gone wrong. A big tech company tries to buy a smaller AI startup, regulators step in, deal falls apart. Happens all the time, right? But this situation is very different. It is not just about business. It is about power, control, and the future of artificial intelligence at a global scale. And more importantly, it reveals how deeply the United States and China are now locked in competition over AI dominance. Let me set the stage before going any deeper. Manus was not just another startup. It was a fast-rising AI company originally based in Beijing, co-founded by Xiao Hong and Ji Chao. These were not minor figures. They were part of a new generation of Chinese AI talent, highly technical, globally connected, and increasingly valuable. Now, sometime in 2025, Manus made a strategic move. They relocated their headquarters from China to Singapore. On paper, that looks like a normal business decision. Singapore is a global tech hub, a stable, business-friendly, and well-connected international hub. But according to Chinese regulators, this move raised red flags. They believed Manus was attempting what is now being called Singapore washing. In simple terms, that means shifting your corporate identity to another country to avoid domestic rules, especially around sensitive technologies like artificial intelligence. And that is where things start to get serious. In January 2026, Chinese authorities began investigating Manus not publicly at first, but behind the scenes. The focus was very specific: whether the company was trying to transfer advanced AI technology out of China without proper oversight. Then things escalated quickly. Meta stepped in with a proposed acquisition valued somewhere between $2 and $3 billion. That alone tells you how valuable Manus was. For Meta, that was not just an investment. It was a strategic play. Think about where Meta stands right now in the AI race. They have made huge strides with open models, infrastructure, and research. But they are still competing with players like OpenAI, Google, and a growing list of Chinese firms. Acquiring Manus would have given Meta access to new talent, new models, and possibly new techniques that could accelerate their progress. But from the perspective of China, that looked very different. To Chinese regulators, it was not just a business deal. It was the potential export of strategic technology and talent to an American company. So in March 2026, Manus co-founders Xiao Hong and Ji Chao were called into meetings with the National Development and Reform Commission, often referred to as the NDRC. Now, just in case viewers are not familiar with the NDRC, we introduce it a little bit first. It is one of the most powerful economic planning bodies in China. When they get involved, it means the issue has gone beyond routine regulation. It becomes a matter of national interest, and then came the travel restrictions. Both executives were prohibited from leaving the Chinese mainland. Not arrested, not charged, but restricted. That is an important distinction. It is what officials describe as guidance rather than formal detention. But in reality, it sends a very clear signal. The Chinese government is asserting control. And this time, transparently. Now imagine being in that situation. You are running a global AI startup, negotiating a multibillion-dollar acquisition, and suddenly you cannot leave the country. That alone changes everything. Behind the scenes, the investigation focused on three main concerns. First, technology export controls. China has been tightening its rules on which AI technologies can be transferred abroad. These are not just commercial tools. Many AI capabilities have dual-use potential, meaning they can be used for both civilian and military purposes. Second, the Singapore relocation. Regulators wanted to know whether Manus deliberately moved its headquarters to avoid Chinese oversight. If that were the case, it could be seen as an attempt to bypass national regulations. Third, foreign investment rules. Specifically, whether the structure of the deal violated policies governing Chinese entities receiving or transferring foreign ownership. And all of this built up to a decisive moment. On April 27, 2026, the NDRC officially blocked the acquisition. Not just paused it. Not just reviewed it. Blocked it and ordered it to be unwound. That is a big deal. Because reversing a completed or near-completed transaction is rare, it indicates a level of urgency and seriousness beyond normal regulatory caution. So what does this actually mean? Let us break it down. For Meta, that is a strategic setback. They lose access to a promising AI company and the talent behind it. In a race where every advantage matters, that is not trivial. But more importantly, it signals that American companies will face increasing barriers when acquiring or partnering with Chinese AI firms. In the video published 2 days ago, we talked about the intensifying AI race between China and the United States. If you haven't watched it, follow the link in the description for a more profound understanding. Now, let us talk about the rising AI startup. For Manus, the situation is even more complicated. They are now caught between two systems. On the one hand, they tried to globalize by moving to Singapore. On the other hand, they remain tied to China through their founders, their origins, and likely parts of their operations. That puts them in a kind of limbo. And for China, this move reinforces a broader strategy. Keep critical AI capabilities within national boundaries. Control the flow of talent. And prevent strategic technologies from being absorbed by foreign competitors. Now let us zoom out a bit. First of all, it is not happening in isolation. Over the past few years, both the United States and China have been tightening controls around technology. Export restrictions, investment screening, talent programs, and data governance are all becoming more restrictive. AI sits right at the center of this. Why? Because AI is not just another industry. It is a foundational technology. It affects defense, economics, information systems, and even cultural influence. So when a company like Manus becomes the target of a foreign acquisition, it is not just about valuation. It becomes a geopolitical issue. And that is exactly what we are seeing here. Secondly, there is another point worth noting. The idea of Singapore washing highlights a growing trend. Companies are trying to position themselves as global entities to avoid being tied too closely to one regulatory system. Singapore has become a popular destination for this. It offers neutrality, strong legal frameworks, and access to global markets. But this case shows that simply relocating on paper does not necessarily remove deeper ties. Governments are looking beyond headquarters and are not just looking at addresses. They are looking at where talent comes from, where research is done, and where intellectual property originates. So even if Manus moved to Singapore, Chinese authorities still saw it as fundamentally connected to China. And that raises a bigger question. Can AI companies truly be global anymore? Or are they inevitably going to be pulled into national spheres of influence? Right now, it looks like the latter. Here, Clara wants to raise a question. Suppose China, like the United States, imposes stricter controls, stating that even if the company involved uses 1% of Chinese technology or hires, directly or indirectly, any employees of Chinese origin, it will still be considered a Chinese entity and be obligated to follow Chinese rules. What will happen next? Although the chance of China becoming another bully like the United States is low, we cannot rule out the possibility. Unfortunately, we are moving toward a world where AI ecosystems are increasingly divided. Not completely isolated, but definitely more controlled. And deals like this one are becoming flashpoints. Now, let us talk about the human side of this story. Because behind all the policy and strategy, there are people. Xiao Hong and Ji Chao are not just executives. They are engineers, founders, and innovators. They built something valuable enough to attract a multi-billion-dollar offer. And now they are navigating a situation in which their mobility is restricted, and their company is under intense scrutiny. That is a tough position. It also sends a message to other entrepreneurs. If you are working on advanced AI in China, your ability to exit, to sell, or to partner internationally may be limited. Not impossible, but definitely more complicated. And for global investors, it introduces new risks. You might identify a great company, negotiate a deal, and still have it blocked for reasons that go beyond traditional business considerations. So where does this leave us? In the short term, the Meta-Manus deal is over. Unwound, blocked, done. But in the long term, it is part of a much larger shift. The AI race between the United States and China is not just about who builds the best models. It is about who controls the ecosystem. Who owns the talent? Who sets the rules? And increasingly, governments are stepping in to shape those outcomes. This case is a clear example of that. It shows that AI is now considered strategic infrastructure. Not something that can be freely traded or transferred without scrutiny. And it suggests that the era of easy cross-border collaboration in AI may be coming to an end. At least at the highest levels. So if you are watching this space, keep an eye on deals like this. Not just the big headlines, but the underlying patterns. Because what happened with Meta and Manus is not a one-off event. It is a signal. A signal that the rules of the game are changing. And that the future of AI will be shaped not just by engineers and companies, and honestly, we are probably just getting started. As mentioned earlier, watch the video about the AI race between China and the United States before looking away from the screen. The link can be found in the description, the pinned comments, and the end screen. Click it, watch it, and you will have a better understanding of what is going on now.